What if every time you wanted to buy a stock, someone paid you first, just for agreeing to buy it? Not after. Not if. Before you own a single share, cash hits your account. That's a cash-secured put, and most investors have never heard of it. In this video, I'll show you exactly what a cash-secured put is, how it works with real numbers, and why it beats every other way of buying stocks. If you saw our covered calls video, this is the other half. Together they form the wheel strategy. And by the end of this video, you'll see how the whole machine works. The problem with buying stocks. Normally, here's how most people buy a stock. They see a company they like, they think the price is fair, they buy it. Simple. Except they get nothing for making that decision. No reward for the research. No compensation for the risk. Now imagine a different version. You see a stock trading at $50. You think $45 would be a great price. Instead of setting a limit order and waiting, you sell a cash-secured put at the $45 strike. Someone pays you $150 in premium immediately, cash in your account right now, for agreeing to buy the stock at $45 if it drops there. Same stock, same intention to buy, but one version pays you $150 and the other pays you nothing. Real example, stock is at $50. You want to own it at $45. You sell one cash-secured put at $45 strike, expiring in 30 days. The buyer pays you $150. That money is yours immediately. Your broker holds $4,500 as collateral. The cash you'd need to buy 100 shares at $45. That's the secured part. Two outcomes. Scenario 1, stock stays above $45. Option expires worthless. You keep the $150. Your $4,500 is released. That's a 3.3% return in 1 month just for being willing to buy a stock you already wanted. Then you do it again. Scenario 2, stock drops below $45. You buy 100 shares at $45, but you already collected $150, so your real cost basis is $43.50 per share. You got paid to buy the stock at a discount to the discount. Now you own the shares, and you start selling covered calls on them. That's the wheel. Why this beats a limit order. Every time a limit order and a cash-secured put have the same goal, buy a stock cheaper, but they're not the same trade. Limit order, you wait. You get nothing while you wait. If the stock never hits your price, you get nothing. Cash-secured put, you get paid while you wait. If the stock never hits your strike, you keep the premium. If it does, you buy it at the price you wanted, plus you keep the premium. There is no scenario where the limit order wins. You're doing the same thing, waiting to buy at a lower price. But one version pays you and the other doesn't. The only reason more people don't do this is nobody told them it was possible. Only sell cash-secured puts on stocks you genuinely want to own. High premium means high risk. Stick to SPY, QQQ, Apple, Microsoft. Smaller premiums, real consistency. Consistency is how you build wealth, not lottery tickets. Cash-secured puts, covered calls, two sides of the same coin. Next video, we combine them into the wheel strategy, a system that generates income whether a stock goes up, sideways, or slightly down. 3 out of 4 market outcomes work in your favor. Subscribe so you don't miss it, and drop a comment with the stock you'd run your first cash-secured put on. I read every single one.